I'm from Wolverine Trading. I'm from the market making side. Wolverine has a number of different entities in it, but I'm from the prop group, the proprietary group in market making, focusing on ETFs, as well as futures, cash products, everything but options. Ironically, Wolverine is specialized in options trading, so I'm in the group that does everything but options. There's like three things I guess I want everyone to walk away with as I talk about ETFs. And that is, one, to question things. Products trade strangely. There's different prices, sometimes it don't make sense. Sometimes the product is it's trading in a strange sort of way. Don't assume that you're wrong and the market is always right. I can't tell you how many times that you question things, and by the time you figured out that you were right, the market adjusts itself and gets back in line. Second, the market is not efficient. No matter what you learned in school, CAPM, the whole thing, it's not efficient. It's more efficient than it used to be, but there are opportunities, and the fact that it's not efficient is the reason why we market makers can make some money. And the third is innovation and adaptation. That is critical. If you don't innovate, if you don't adapt, you die. Don't be static. Don't accept mediocrity. None of you accepted mediocrity in school, or you wouldn't be here today. And it's a very competitive market out there, so constantly innovating, constantly adapting is what makes things, is what makes opportunities occur. So quick background, very, very quick. I graduated in '85 from Wharton. I started in investment banking and reinsurance, and after a few years, finally woke up and realized that trading was my passion, and came back to Chicago, went right to the CBOE. I traded in the SPX pit, options pit, as well as the OEX pit for about 7 years. I was on the product development committee. Back in '93, we actually developed the VIX index, and as someone said earlier, I think Jeremy from Batsy's products take a long time to be created. So we created the index. It started disseminating in '93, and it wasn't until '04 that the first futures product actually traded on the CBOE, or on the CFE. I left the floor in '96, incorrectly thinking that the floors were going to go away and everything was going to go electronic, but I'm glad I did. So I started my own firm, eventually was acquired by Wolverine in '06, and my team and I have grown there and are now fully part of Wolverine ever since. The main product that started in the mid-'90s that really became our focus were ETFs, and they still are to this day. So as I said, here's a definition of an ETP. ETP stands for Exchange Traded Product. An Exchange Traded Fund, or ETF, is one of the class, is the most popular of all ETPs. Other ETPs include ETNs, like Exchange Traded Notes, and there's Exchange Traded Vehicles, ETVs, but ETFs are what we're going to focus on here. And it's basically a security, so it trades just like any other stock, trades intraday, and it's derivatively priced. There's an underlying basket that makes up that ETF. Usually a commodity, currency, or an interest rate product, could be a volatility product, and they're always benchmarked to something. So as Jamie was talking about, most of them are benchmarked to an index, like the S&P 500, but they can also be benchmarked to a commodity, like crude oil. And then there's also the actively managed ones, or the smart beta ones, or, well, smart beta is actually something different, but there's actively managed ETFs, which change every day based on the active manager, a little harder to hedge, but they still have to daily disseminate what their holdings are. So before I move forward, I'm going to just show you 2 slides here, explain something here really quick, and then challenge you guys to something to think about and come to back at the end. So this is a forward curve. I don't know how many of you are familiar with forward curves. So this is for Brent oil. So over here are prices, and this is time. So this is the spot price. This is the front month price for Brent oil, and it shows the the prices of all the futures that are trading going forward on the curve. This part of the curve is we call contango. What that means is the following futures are all trading at a higher price. And then, as you can see, sometime around mid-2015, it goes backwardated, which means the prices start to drop. This is the forward curve for WTI futures. That's the West Texas Intermediate future. So there's just two different types of crude oil futures. And you can see this forward curve is all backwardated. So here's my question. You have two ETFs. One's backed by WTI. It's actually called USO. One's backed by Brent, this one, which is called BNO. Those are the two stocks. Assume the two crude contracts they're relatively correlated. They're going to stay in line with each other as the spot contracts as they move forward. Which ETF would you want to own? So think about that. We're going to come back to that. Brief history of ETFs. As we heard, the first major ETF that really actively traded was the SPY in '93. Many other issuers have joined the fray. State Street really created the whole SPDR family. Spiders, Diamonds, GLD, which is backed by gold, MDY, which is backed by the mid-cap 400, Barclays, which is later sold to BlackRock, manages the whole iShares family, plus the MSCI family of ETF products, Vanguard, Invesco, which owns the power shares of the Qs, which is the NASDAQ 100, ProShares, which are all the leveraged ETFs, where you can get 2 times or 3 times, both plus and minus many different indices. The first bond funds weren't introduced until '02, not that long ago, on treasuries. And the first ETFs on munis and junk bonds weren't introduced until 7 years ago, in '07. And actually, I think some of these numbers are even higher now. I think there's over 1,600 ETFs now, and we're actually approaching $2 trillion in assets. So this is a chart of the growth in terms of, in blue there, it's actually the total net assets. As we said, now it's closer to $2 billion already, I think a little bit under. And then at the top there, that's the number of ETFs, and that actually is also growing. And what we wanted, first of all, the reason Wolverine is excited about ETFs is we think this is going to continue to grow. It may not continue to grow in terms of new ETFs launched, although it might. We think it's going to continue to grow with assets under management. It's actually probably going to be both, but it's an exciting, definitely an exciting product class for our industry. So the reasons for its popularity, I'll go through this kind of quickly. To compare them to mutual funds, which is back in my day when we were putting money aside to save, you basically had mutual funds or single stocks and that was it. But with ETFs, it has really become, it is almost displacing mutual funds for a variety of reasons. And here's 5 of the reasons, but there's probably many more. One is lower costs. They have lower expenses than mutual funds. They don't turn over their portfolio as much. There's a whole process out there called creation redemption, which I'm going to get to in a second, which actually is one of the reasons that the cost stays so low. They're very flexible. They trade like a stock. You can short them. You can margin them. You can sell options against them. You can't do any of those things with a mutual fund. Tax efficiency. They're relatively low capital gains tax rate. Again, it's partly because of the creation redemption process. The issuers themselves don't have to meet investor redemption, so there's not a lot of selling going on. It's done mostly through this creation redemption process, which avoids the capital gains to the product itself. And it gets a little complicated, but I'm going to touch on that later. And then market exposure and diversification. There's no better way for a money manager to jump into a sector or an international exposure or an index exposure than just buying the ETF. We see a lot of managers now, it's actually become extremely popular where their entire portfolio is ETFs. And they own millions of shares or short millions of shares, and they are just rotating through and rebalancing using ETFs and not even buying or selling a single stock. And then transparency, which we think is the best part. Every day, these ETF issuers have to disclose all their holdings publicly. Everyone in the marketplace can download them and see exactly what these ETFs hold every single day. And that actually allows market makers like Wolverine to actively trade against the ETFs and hedge those ETFs, knowing exactly what we can create or redeem with it. One thing I just want to emphasize is this whole network of issuers, exchanges, market makers is very unique, and is really what makes this industry, within this industry, that's such a fantastic product. We all have to work together. We talk to the issuers almost every day. We talk to the exchanges almost every day. They were in our office this morning. Some of the head sales guys from State Street played volleyball with us yesterday, actually, and beat us. The reason it's so important is we all have the vested interest. We all want the liquidity. We all want the transparency. We all want to keep the tracking error low. What I mean by that is you want the ETF to reflect the underlying index or the underlying commodity as closely as possible. So whenever there's a problem with a price or there's an issue with one of the underlying securities in the portfolio, it's up to us as the market makers to talk to the issuer and say, hey, something's wrong here. The exchanges talk to us because they want the liquidity. They want people to create bids and offers all day long on the products that they list on their exchanges. So that triangle, those three groups are actively working together with the same goal in mind. So it's very important to know what is in your ETF, to really understand the structure of the ETF if you want to be trading it and what it holds. One quick story that just really solidified the importance of understanding what you trade for me. I was in the OEX for many years, and there was a very large, one of the biggest volume traders in the pit who stood right near me. I was actually very intimidated by him for years. He not only was the biggest trader in the pit, he was literally the biggest trader in the pit. And there was one day where the combo, let's see, how do I say this? The front month options, the combo, they were basically where the front month was trading, all of a sudden shifted dramatically and moved to the second month. So there was like a downward move in the front month, upward move in the second month. And it took a lot of people off guard, but some people kind of knew what was going on. And I remember he turned around and he's like, what the hell happened? And I said, well, GE announced that they moved their dividend. They moved their dividend forward a week, and the dividend left the first month, went to the second month, and that would affect the price from one month to the next. He said, well, what does that matter? What does GE have to do with the OEX? I was like, well, GE is a large product that makes up the OEX. And he's like, oh, and he went back to trading. And I was just floored. I was like, how could this guy who traded a significant amount of volume in our pit every day, day in, day out, not even know what the makeup of the index was? And he was trading this for years. And he really didn't care. He was looking at a sheet of theoreticals. He was trading options against options, focusing on butterfly spreads and things like that. And he really didn't care. It didn't bother him. It didn't affect him. I don't think the business is much like that anymore, but for us, it is critically important you know what makes it up. So I'm going to go back, let's see, to this. Now, how many people thought, and this kind of hits that point home about knowing what you trade, how many people thought Brent is the better ETF to hold over WTI? How many people think WTI is the product to hold? Or everyone has no opinion. Okay. If you understand how the products work, these ETFs basically hold the crude oil futures and roll them forward every month. So they're long, where is that? They're long the first, let's say, 3 or 4 months of these, or they're long the first 3 or 4 months here. And then as they come to expiration, they roll them forward. Well, if you roll this forward, you're basically buying a future that's lower than the one you're selling, right? Every month you're buying one, you're receiving a credit every time you roll. And by the way, this isn't always the case. This just happens to be where these futures are trading now. They could be exactly flipped 2 months from now. All right, and understanding backwardation and contango is a whole other discussion that John will get someone to speak about next time. And here, every time you buy the month in front of you, you're paying. You're paying to roll forward. So just at the moment, if someone came to me and said, God, I just want to own crude oil, and I'm going to buy an ETF. What do you think? Should I buy Brent or WTI? Does it matter? Well, it does matter. This product is going to be much less efficient for the foreseeable future versus the Brent. They're going to be spending money to roll their underlying versus Brent with WTI, which is actually going to receive a credit. So again, the importance of understanding, especially from if a money manager called us or someone who didn't really know this, we would be happy to explain to them that. But our job is really just to hedge it and make sure we're along the right portfolio. So Wolverine doesn't own these things in terms of making a bet on them. We're just keeping the markets in line. But it's very important to understand how these things trade. So again, I want to get to my final points. Question things like this, right? Question things. Understand how they work. Know the details of what you're trading. Market inefficiency. As I said, market's not efficient. Things trade out of line all the time. We're always looking at the basket of what everything that these ETFs hold, how they relate to the ETFs, and what their NAV is, their net asset value. They always trade, not always, they very often trade at premiums or discounts to that NAV. Why? Okay, that's the trader's job. Why? There's lots of reasons, right? Things could be difficult, hard to borrow. There could be some international exposure that's difficult to get, that's trading at different times. There could be low liquidity. There's lots of reasons. The trader's job is to understand why. And third, innovate and adapt. As I said, there's so much happening in our industry, new technologies, new exchanges, new ideas, new products. And if you're not innovating and adapting, if you're not making those changes, what you're doing is going to just, is not going to be competitive anymore. And a perfect example of that is a lot of times we trade and we found some strategy where we're able to make the trade work well for us. And if we're just sitting there and doing nothing, there's someone else in the marketplace who's pretty big, who's changing what they're doing. And when they change something, it affects our pricing. And then we're sitting here scratching our heads saying, hey, what happened? This used to work and it's no longer working. You want to be the one making those changes. You want to be the one innovating and adapting, making the changes, forcing the other guy to say, hey, what the hell happened here? Because if you don't, you're always going to be the one who's behind the eight ball there. So that's all I got to say. And good luck to everyone and happy trading. And thank you.